Tina Mitchell here with your Money Chat. The JOLTS survey, job opening and labor turnover, showed that the total amount of job openings dropped 400,000, but from very high levels from 11.7 million to 11.3 million. This is an early sign that the economy is slowing and companies are pausing on their hiring. Initial job claims, which measures individuals filing for unemployment benefits for the first time, increased by 4,000 to 335,000. While this is still very low level in the initial claims, the 4-week moving average is at its highest since December and has been consistently moving higher. Continuing claims, which are those that continue to receive benefits after their initial claim, increased by 5,000 to 1.373 million, which is the highest reading since late April. The ADP would have normally released their employment report for June, but they announced that they are retooling their national reemployment report to provide a more robust, high-frequency view of the labor market and trajectory of economic growth. In preparation for the changeover to the new report methodology, they are pausing the current release and have targeted August 31st, 2022 to reintroduce the new ADP National Employment Report. The Atlanta Fed has revised their Q2 GDP estimated from 0% to negative 2.1%, following some weak economic data that we've seen. Now, after a negative 1.6 first quarter final GDP reading in the Atlanta Fed is correct, we could have 2 consecutive quarters of negative GDP. So does this mean that the reference for recession of the NB of Economic Research will call a recession soon? Well, it's important to note that we will not get the final Q2 GDP reading until 3 months after the quarter ends in September. But let me share the NBER's commentary on how they call for recessions. The definition emphasizes that a recession involves a significant decline in economic activity and is spread across the economy and lasts for more than a few months. Now, there are 3 main criteria: depth, diffusion, and duration. While each needs to be met individually to some degree, extreme conditions revealed by one criteria may partially offset weaker indications for another. Now, for an example, in the case of the February 2020 peak in economic activity, the committee concluded that substantially dropped activity had been so great, so wide and diffuse throughout the economy that even if proven to be quite brief, the downturn should be classified as a recession. Now, the economic data the NBER pays most attention to are real personal income, less transfers, non-farm payroll, and employment. Employment is measured by the household survey, real personal consumption expenditures, wholesale and retail sales adjusted for price changes, and industrial production. In recent decades, the 2 measures that we have put the most weight on are real personal income, less transfers, and non-farm payroll and employment. The committee makes a separate determination of the calendar quarter of the peak or truth based on measures of aggregate economic activity over the relevant quarters. Now, 2 measures that are important in the determination of quarterly peaks and troughs, but that are not available monthly, are expenditure side and income side estimates of real gross domestic product, or GDP and GDI. The committee also waits to identify a trough or period of time after it has actually occurred. With that being said, while 2 consecutive quarters of negative GDP is not the official definition of a recession, the reason why it became a Wall Street rule of thumb is that we have never had successive quarterly declines in the real GDP without there being an actual NBER defined recession eventually. So I believe the formal announcement that we are going to see a recession is going to be coming soon. The good news: mortgage interest rates historically favor well during a recession, so we most likely will see mortgage interest rates decrease. Tina Mitchell, and that is your Money Chat.